So at this point we've been pre-qualified, and you have your pre-qualification form in hand. So you've reached out to a local realtor, or we've put you in touch with one, and and you go out looking, and you're ready to find a property. You've got your wife and your kids and your dog, and you're out, and you finally find you actually find a property that you love. You find your dream home, and this property is actually is listed at $250,000. And based on what we've already talked about, you already know your down payment portion. And let's say, for example, you've decided you're going to put 5% down, and that's comfortable for you, and the payment on that is comfortable for you, and so you're going to finance then the remaining $237,500. That's going to be your new loan amount. And you know that's comfortable, but the question becomes, what are my closing costs? And that's what we're going to try and break down in this video here today, is what are my closing costs? Because unfortunately it's just not that easy for a lender to be able to tell you exactly what your closing costs are. There's a handful of different things that go into your closing costs, a combination of what type of property it is, what type of transaction it is, and then what time of month you close on your property. And then lastly, what type of loan program we're going to do, and we'll get that into future videos, as far as different ways we can structure the loan, the interest rate, the closing costs. All will go into what are your closing costs. So today, I just want to break down and help explain what these closing costs are, and exactly why it's so hard to determine these exact amounts when you're out looking at a property. So we're going to break this into a couple different colored areas here. The first one is going to be the lender fee. So red is guaranteed rate, and these are the costs of the Miksta Team. Lender fee is going to be $9.90. We're going to look at a credit report and flood, and we don't charge anything up front to apply for a mortgage. So these are just loans or costs that you incur as you close on the mortgage. The exception to that would be the appraisal, which typically you're going to pay for that up front, and we would have to get that ordered through us. The appraisal is going to range. That could be anywhere from $250. Chicago, we have a discount where it's about $250, up to $400. Typically in Arizona, it's $350 to $400, and then can be over that if a much higher priced home in a higher priced appraisal. The next section we're going to break down is actually the title fees, and this again, so as you look to put an offer in, we don't know which title company it's necessarily going to be. So it's hard for us to say exactly what those title fees are going to be until we get them from the title company. But the different types of fees that they have, an escrow fee, and I'm just going to estimate that at $500. It can vary, quite substantially from one title agent to another. Insurance then, title insurance, which we're going to explain in future videos, but that will range based on the loan amount, and that cost can be anywhere from $600 to say $1,500 on a super high loan amount. For the sake of this $250,000 transaction, we're going to go ahead and say $800 for the title insurance on this $250,000 house. Miscellaneous, then any miscellaneous fees. So if there's a notary, a courier of any loan or of any documents, recording fee, which will depend on the title company, the state, all these different things. So total, the title fees, we're going to estimate on this $250,000 house, we're going to estimate those at $1,500. And then I'm actually going to go back and calculate. We're going to assume the appraisal at $350, so $350 plus $990 plus 10. So the lender fees we're going to estimate at $1,350. Moving on, there's going to be a couple different, just depending on the transaction. I'm going to put these in purple, just depending on what type of transaction it is. There might be additional fees. One common would be like an HOA transfer fee. So if it's a condo, if it's a townhome, if it's even a house with an HOA, you might have to pay an HOA transfer fee, and those can vary. And then I'm also going to put on here a short sale, because this can be common, a short sale negotiation fee. If it is a short sale, this might be written in the contract. And these two you're just going to want to get with your realtor and with the title company to understand what these costs are. And the sooner you can do that, the better, because we might not get this information for some time. In addition to that, there's one optional cost that comes up, and as part of your closing costs would be a home warranty. And a warranty is something as well. Talk with your real estate agent if you want to get one of these, but you're going to want to factor this in. And those can be from like $350 to $500. And then lastly, what I want to include in here is just depending on the state that you're in, the state and county that you're in, there might be additional costs. So in attorney states, there might be an attorney fee. This is common in the state of Illinois. This could be anywhere from $500 to $750. And then also transfer taxes. So a tax that some states or counties put to transfer title into your name. And a good example of this is going to be Chicago and Cook County. There's none of these in Arizona, but check with your county, check with your realtor, see if there are these costs. In Illinois, it is, for this example, would be $7.50 per 1,000. So the quick math on this, we're going to pull up our calculator here, and we're going to say $7.50 times 250,000, which is our purchase price, divided by 1,000, gives us an additional $1,875 in transfer taxes, and that's paid to Cook County. So that can be a substantial amount of money, especially as we get into higher price ranges, that you just want to check in and make sure you understand what those costs will be to you. So now we've calculated our closing costs, but there's additional costs that we also pay at closing. They're not technically closing costs, but what we will call them are actually our prepaid items. So these prepaid items are monies that you will pay at closing, but they're not technically closing costs. And there's three different categories that we're going to break down here, and the first one is going to be prepaid interest. So let's say, for example, we close on this property January 17th. January 17th through the end of the month, and actually through February 1st, that would be 15 days of prepaid interest. So on January 17th, we would pay 15 days of prepaid interest, and that would pay us good through up until February 1st. So that calculation is just 237,000, so it's based on the loan amount, 237.5, and we're going to multiply by the interest rate. So let's say we're at 4.5%, and then divide by 365 days, so the total number of days in the year, and that will get us our per diem. And then multiply by this 15 days, because we'll always prepay it through to the end of the month. So calculation wise here, we're going to do 237,500 times 0.045 for the interest rate, divided by 365 days. So that gives us 29.28. That's our per diem, and then 15 days. So we're going to prepay 15 days of that. So our total cost comes out to $439.21. So $439.21. So that's the prepaid interest expense. Then we're going to have, and we'll change colors here, your insurance. So whatever the annual hazard insurance, not mortgage insurance, but hazard insurance. So if you go to a insurance agent, they're going to insure the property, and they're going to collect that say it's an $800 policy, they're going to collect that at closing. So this is a prepaid item, and that'll pay your insurance for the year. You're going to pay that in advance, so you don't have to worry about paying that. And typically then you're going to if you elect to set up an escrow account, and this will tie into the next section here. So we're also going to set up this escrow account and pay a portion of the taxes. So depending on when you close, let's say that taxes are $200 a month, and let's say just based on when we close, let's say we're taking 6 months worth of taxes, and that's a pretty good estimate. So that would be $1,200. So this would either go into your escrow account, or if taxes were due, would go to the county. It just kind of depends. In addition, the taxes, it's kind of tough because depending on when you close on this property, you also could be credited back money from the seller for the portion that they've lived in the house. So if we go back to January 17th as our closing date, if taxes were last paid, this would, the last collect through say the second part of last year, so mid last year, then basically you would get a credit for the amount of taxes that the seller has been living in the property. So all of this is going to cancel out, but if we make these estimates, and I'm going to circle all of these closing costs, this will give us an idea of what our total closing costs are going to be. So $2,850, and then any of these you would have to add on additionally. So if any of those on top of what we're adding up here, $439, $800 for the insurance, $1,200 for the taxes, and you might be getting a credit again for a portion of these taxes, but I'd rather estimate on the high side than anything. So adding all of these up, we have $1,350 plus $1,500 plus $800 for the insurance, $1,200 for the taxes, plus $439.21. So our total closing costs in prepaid items is $52.89.21. So $52.89.21. And real quick, I want to go over this prepaid interest because it's interesting to note that we're paying 15 days. So if we closed on January 7th, instead of paying 15 days, we'd pay 25 days. So this prepaid interest amount would have been higher if we closed earlier in the month. And all of that cancels out because if we close, no matter when we close in January, if we prepay the interest through the end of the month, our first payment is not going to be until March 1st. So we're prepaying the interest through the end of the month, and the way mortgages work, we calculate interest in arrears, which I'll explain in other videos. But basically, we're prepaying the interest through the end of the month, and if we close earlier in the month, yes, we'd be coming in with more money at closing, but it basically means you won't have a mortgage payment for could be close to 60 days. So looking at all of this, we've added all of these up, your closing costs, your prepaid items. So now we've come to the conclusion that these are your total closing costs and prepaids, as an estimate on this property, and now we have something to go off of. And in the next video, we'll talk about basically how we structure this offer price, and then also different ways we can structure the loan to absorb these costs and make sure that once again we are comfortable moving forward with this house. So we know that we can afford a $250,000 house with a 5% down payment, meaning this loan amount, meaning that's whatever that payment calculates out to be, and also that we're not coming in with all of the money that you have to be able to close on this property. So we will make sure that we're comfortable, but it starts with understanding your closing costs and how how these can depend on when you close, and in several other things within the transaction.